Welcome back, everybody. Today, we're going to be taking a deep dive into a topic that can really make or break a trader, and that is overtrading. We've got some super intriguing articles lined up for you guys, some in English, some in Farsi, and I think the combination of those is going to bring some really unique insights.
Yeah, for sure.
And even if you're not a trader yourself, the psychology behind all this is fascinating. I mean, we're talking about discipline strategy, really understanding your emotional responses,
Right.
things we all deal with in life, right?
Oh, absolutely. And you know what we're going to be unpacking today goes way beyond like that surface level advice that you usually hear.
Yeah.
You know, we're going to look at how to actually like implement these concepts into a real trading strategy.
Okay, so for anyone who isn't familiar with the term, let's start with the basics.
Sure.
What exactly is overtrading, and how does
Right.
it differ from just, trading frequently?
That's a great question. It's not just about the number of trades,
Yeah.
It's about the intention behind them. So, like a novice trader, someone who's prone to overtrading, they might be glued to the screen, chasing every little fluctuation, making those impulsive decisions based on fear or FOMO, that fear of missing out.
Right.
They haven't developed that discipline to stick to a plan.
So it's like they're reacting emotionally to the market noise,
Right.
rather than responding strategically to actual signals.
Exactly.
Hmm.
On the other hand, a seasoned trader might make just as many trades, but each one is going to be carefully calculated,
Right.
part of a larger strategy. They're playing the long game, not getting caught up in those short-term swings.
And that's where the real danger of overtrading lies, right?
Yeah.
It's not just about losing money on a few bad trades. It can actually sabotage your entire approach to the market.
Oh, it absolutely can. Overtrading can totally derail your strategy, leading to a cascade of negative consequences. You start making impulsive decisions, your risk management goes out the window, and you can even experience like emotional burnout.
Wow. Losing confidence in your abilities?
Right.
It really becomes a vicious cycle.
So how do we break free from that cycle?
Yeah, that's the question, isn't it?
Both of the articles we have today offer some really practical advice, and one thing they both emphasize is the importance of planning.
Yeah, planning is absolutely crucial.
Yeah.
And we're not just talking about having like a vague idea of what you want to do. I'm talking about developing a detailed trading plan, a roadmap for your week. For example, one of the articles written by a trader in Tehran
Okay.
suggests using the weekend when the markets are closed to really analyze the previous week's performance and identify potential setups for the coming week.
I love that idea.
Yeah,
Using the weekend to strategize really takes the pressure off making those reactive decisions during the trading week.
totally.
But how does that translate into a concrete plan? What kind of things should traders be focusing on during that weekend analysis? Well, you want to look for patterns. Identify trends and pinpoint specific entry and exit points for potential trades. This is where some technical analysis comes in. You might look at indicators like moving averages, MACD, or Bollinger Bands to gauge momentum and volatility. The goal is to have a clear idea of your trading strategy before the market opens on Monday morning.
So it's almost like pre-committing to a certain course of action.
Right.
That way, when the market opens and things start moving, you're less likely to get swept up in the frenzy.
Precisely. Having a predefined plan helps you stay disciplined and avoid those impulsive trades driven by fear or greed. You're essentially taking emotions out of the equation as much as possible.
Now, another common thread I noticed in both articles was the emphasis on slowing down
Yeah.
and shifting your focus to the long game.
Yeah.
What exactly does that mean in the context of trading?
It's about resisting the urge to constantly chase those short-term profits. Instead of analyzing hundreds of candlesticks on a 1-minute chart, try zooming out
Right.
and looking at daily or even weekly charts. You'll get a much clearer picture of the overall market trend and be able to identify higher probability setups.
That makes a lot of sense. It's like the difference between trying to navigate a city by looking at individual buildings versus using a map to see the whole layout.
Exactly.
You get a much better sense of direction.
And it's not just about getting a clearer perspective. Focusing on the long game also helps you avoid those emotional trades. When you're constantly staring at short-term price fluctuations, it's easy to get caught up in the excitement or the panic of the moment.
Right.
But when you're looking at the bigger picture, you're less likely to react impulsively to those swings.
So it's about cultivating that patience and discipline to wait for the right opportunities rather than jumping in and out of trades constantly.
Exactly. It's a mindset shift. You're moving away from the get-rich-quick mentality and embracing a more sustainable approach to trading.
And this brings us to a tip that at first glance might seem a bit counterintuitive, setting a maximum number of trades per week. Why would we want to limit ourselves?
Well, it might sound strange, but setting these self-imposed limits can actually be incredibly liberating. When you force yourself to be more selective, you're naturally going to choose only the highest quality trades. You'll think twice before entering a trade,
Uh-huh.
analyzing it more carefully to make sure it aligns with your strategy.
So instead of feeling like you need to be constantly in the action,
Right.
you're taking a more measured approach, waiting for those prime opportunities.
That's right. You're not just reacting to every little market fluctuation, you're actively choosing your battles.
Right.
And you might even find that you choose not to trade at all on certain days, especially if the market is particularly volatile.
Yeah.
You mentioned earlier about a trader in Tehran. Their article specifically mentions how they avoid trading on Mondays because that's when the market tends to be the most unpredictable.
That's so interesting.
Yeah.
It really highlights how important it is to be adaptable and adjust your approach based on market conditions. But wouldn't that level of restraint be difficult for someone who's prone to overtrading?
It definitely requires discipline, but that's where another key concept comes in, managing your emotions. And this is where the Farsi articles offer some really unique perspectives.
Managing emotions in trading, it sounds almost impossible sometimes. How can these Farsi sources help us with that?
They bring in a fascinating blend of traditional wisdom and modern psychology. One article talks about incorporating mindfulness practices, not just for stress relief, but to become more aware of like those subtle emotional triggers
Yeah.
that lead to impulsive trading.
So instead of trying to suppress those feelings of fear or greed, you're learning to observe them
Right.
without letting them dictate your actions.
Precisely. It's about developing that internal observer, noticing those emotional surges without letting them kind of take over the wheel.
Yeah.
This level of self-awareness is crucial not just in trading, but in like all aspects of life.
It sounds like a powerful way to break that link between emotion and impulsive action. But are there any specific techniques they recommend?
One article suggests something called Naqshbandi breathing. It's a Sufi practice that focuses on rhythmic breathing and visualization. Apparently, traders are using this to stay grounded during like market volatility.
Wow, I've never heard of that before. It's amazing to see how those ancient traditions can be applied to such a modern, fast-paced field like trading.
It really highlights the universal nature of these challenges. Whether you're a trader in Tehran or Tokyo, we all struggle with the same emotional biases.
Speaking of universal challenges, both articles also emphasize the importance of risk management. It's something a lot of new traders overlook, don't they?
Absolutely. It's easy to get caught up in the potential for profits and forget about the downside. But protecting your capital is paramount. It's the foundation of a sustainable trading strategy.
One article had a great analogy. It's like wearing a seatbelt while driving.
Right.
You hope you never need it,
Exactly.
but it's there to protect you in case of an accident.
Right.
But how do we translate that analogy into actual risk management in trading?
One concrete step is to determine your risk tolerance before entering any trade. This means deciding how much you're willing to lose on a particular trade and setting a stop-loss order accordingly.
A stop-loss order for our listeners who might not be familiar. Can you explain what that is?
Sure. It's an order you place with your broker to automatically sell your position if the price drops to a certain level. This helps you limit your losses on a trade that's going against you.
So you're essentially pre-committing to cutting your losses if things don't go as planned,
Exactly.
rather than letting emotions lead you to hold on in the hope that the trade will turn around.
It's about taking a rational, calculated approach to risk rather than letting fear or hope kind of dictate your actions.
Now, beyond setting stop-loss orders, are there any other risk management techniques these articles recommend?
One thing they both emphasize is the importance of diversifying your portfolio. Don't put all your eggs in one basket, as the saying goes. Spread your risk across different asset classes, sectors, or even geographical regions.
So even if one particular trade or market sector is performing poorly,
Right.
you've got other investments that can potentially offset those losses.
Right. Diversification helps you create a more balanced and resilient portfolio that can weather market storms more effectively.
It's like building a house with a strong foundation and multiple supporting beams.
Yeah,
It's less likely to collapse if one part weakens.
that's a great analogy. And it ties into another key principle highlighted in both articles, the importance of continuous learning.
Yes. This is something that resonates with me so much. The market is constantly evolving, new trends are emerging, and technology is changing the landscape at a rapid pace. How did these articles suggest we approach continuous learning and trading?
One of the writers, who's been trading for over 2 decades, emphasizes the importance of staying humble and acknowledging that there's always more to learn. They recommend subscribing to industry publications, attending webinars, and engaging in online forums to stay updated on the latest trends and techniques.
It's like treating your trading journey as a lifelong education,
Right.
always seeking out new knowledge and perspectives.
And don't be afraid to experiment with different strategies and techniques. The key is to find what works best for you, your risk tolerance, and your trading style.
Now, we've talked a lot about the psychological aspects of trading and how to develop a more disciplined approach.
Right.
But let's shift gears a bit and dive into some of the more technical tips these articles offer.
Sure. One area they both delve into is the importance of using multiple timeframes in your analysis.
This is something I've heard experienced traders talk about,
Yeah,
but I think it can be a bit confusing for beginners.
sure.
Can you explain what it means and why it's so beneficial?
Imagine you're looking at a map. You might start with a wide view to get the lay of the land, then zoom in to see specific streets and landmarks. It's the same concept in trading.
So you might use a weekly chart to identify the overall trend,
Right.
then switch to a daily chart to pinpoint entry and exit points for specific trades.
Exactly. This multi-time frame analysis gives you a more comprehensive understanding of the market, helping you confirm signals and make more informed decisions.
It's like getting a second opinion from a specialist before making a major decision.
Yeah.
You want to make sure all the signs point in the same direction.
Well said. And it ties into another technical tip highlighted in the articles, the importance of identifying key support and resistance levels.
Can you explain what those are for our listeners who might not be familiar with these terms?
Of course. Support levels are price points where a stock or currency pair has historically struggled to fall below. Think of it as a floor.
Okay.
Resistance levels, on the other hand, are price points where the asset has had difficulty breaking through. It's like a ceiling.
So by identifying these levels, traders can anticipate where the price might reverse or continue its trend right.
Exactly. Support and resistance levels can be incredibly useful for setting profit targets and stop-loss orders. For example, if you're buying a stock that's approaching a known resistance level,
Okay.
you might set your profit target just below that level, anticipating that the price might struggle to break through.
It's like using historical data to map out potential future price movements.
Precisely. And it's a technique used by both technical and fundamental analysts.
Now let's talk about another crucial aspect of successful trading: choosing the right trading strategy. Both articles seem to emphasize that there's no one-size-fits-all approach.
That's absolutely correct. The best trading strategy for you will depend on your personality, your risk tolerance, your time commitment, and your financial goals.
One article used a fascinating analogy comparing different trading styles to different types of athletes. Some traders are like marathon runners taking a long-term patient approach.
Yeah,
Others are more like sprinters focusing on quick short-term trades.
that's a great way to put it. And it highlights the importance of self-awareness in trading. You need to understand your own strengths and weaknesses and choose a strategy that aligns with your natural tendencies.
So for someone who's prone to overtrading, might a longer-term strategy be more beneficial?
It could be. A longer-term strategy such as swing trading or position trading requires less frequent trading and focuses on capturing larger price moves over days, weeks, or even months.
It's a more patient approach that allows traders to ride out short-term fluctuations without getting caught up in the emotional roller coaster of daily price movements.
Exactly. And it encourages traders to focus on the bigger picture rather than getting distracted by every little blip on the chart.
Now, both articles also touched on the importance of using technology to your advantage in trading. This is a topic I'm particularly interested in.
Yeah.
What kind of tools and platforms do they recommend?
They both emphasize the power of trading platforms that offer advanced charting tools, real-time market data, and customizable alerts. These platforms allow traders to track multiple markets, simultaneously identify potential trading opportunities, and manage their positions efficiently.
It's like having a personalized command center for your trading activities.
Precisely. And many platforms now offer automated trading features, which can be particularly helpful for traders who want to remove emotions from their decision-making process.
Can you give an example of how automated trading might work?
Sure. Let's say you've identified a potential trading setup based on your analysis.
Okay.
You can set up an automated order that will automatically buy or sell a certain amount of a stock or currency pair when the price reaches a predetermined level.
So you're essentially taking yourself out of the equation at the moment of execution,
Right.
eliminating the potential for hesitation or second guessing.
Exactly. Automated trading can be a powerful tool for ensuring discipline and consistency in your trading strategy.
But of course, it's crucial to use these tools responsibly and to have a solid understanding of the risks involved.
Absolutely. Technology can enhance your trading, but it's not a magic bullet. You still need to develop your skills, knowledge, and discipline to succeed in the long run.
Now let's shift gears a bit and talk about a topic that often gets overlooked in trading discussions: the importance of maintaining a healthy work-life balance.
This is crucial, especially for traders who work from home or have flexible schedules. It's easy to get caught up in the markets and let trading consume your entire life.
One of the articles talked about the dangers of screen fatigue and how constantly monitoring charts can lead to burnout, stress, and poor decision-making.
Exactly. It's important to set boundaries and create a clear separation between your trading activities and your personal life.
So simple things like establishing set trading hours,
Right.
taking regular breaks,
Yeah,
and engaging in non-trading activities can make a big difference.
absolutely. And remember, trading is just one aspect of your life. There's so much more to experience and enjoy. Don't let it consume you.
It's so easy to fall into that trap, especially when the market is moving and you feel like you need to be constantly on top of things.
Yeah, it really is. It's like anything else in life, you need balance.
Yeah.
Even professional athletes have rest days to prevent burnout and injuries.
That's a great point. Now, before we wrap up our deep dive into overtrading, there's one more concept I wanted to touch on, something both articles mentioned, and that's the idea of embracing losses as part of the learning process.
That's a really important one. Too many new traders get discouraged by losses and see them as like failures. But in reality, every loss is an opportunity to learn and improve.
It's like that saying, you learn more from your losses than your wins.
Exactly. If you analyze your losing trades carefully, you can identify patterns in your decision-making, pinpoint areas where your strategy might be flawed, and adjust your approach accordingly.
One article suggested keeping a trading journal
Yeah,
to document your trades and analyze your performance. It's like having a personal coach helping you identify your blind spots and improve your game.
I think that's a fantastic practice. A trading journal can help you track not only your entries and exits, but also your emotional state during each trade. This can be incredibly valuable for identifying those emotional triggers we talked about earlier, those moments of fear or greed that can lead to impulsive decisions.
So it's not just about analyzing the technical aspects of the trade, but also understanding the psychological factors at play.
Precisely. By becoming more aware of your emotional responses to market movements, you can start to develop strategies for managing those emotions more effectively.
It's like building that emotional resilience, that ability to stay calm and focused even when the market is throwing curveballs at you.
Exactly. And that resilience is what will ultimately help you navigate the ups and downs of trading and achieve long-term success.
Well, I think we've covered a lot of ground today. We've explored the dangers of overtrading, discussed strategies for developing a more disciplined approach, and even touched on some of the technical and psychological aspects of successful trading. As we wrap up, is there anything else you'd like to add?
Just that I hope our listeners have gained some valuable insights from this deep dive. Remember, trading is a journey, not a destination. There will be ups and downs, wins and losses. But by embracing a growth mindset, continuously learning and developing those essential skills of discipline, strategy, and emotional control, you can navigate the markets with confidence and achieve your trading goals.
That's a great reminder. And I think those principles apply not just to trading, but to so many areas of life. Whether you're pursuing a career, building relationships, or simply trying to achieve your personal goals, those same skills of discipline, strategy, and emotional intelligence are essential. So as we close out this deep dive, we want to leave you with a final thought-provoking question. If you could apply just one of the principles we discussed today to another area of your life, what would it be and what impact do you think it could have?
Take some time to reflect on that. What area of your life could benefit from more discipline, a clearer strategy, or better emotional control? Perhaps it's your finances, your health, your relationships, or your creative pursuits. The possibilities are truly endless.
Keep exploring, keep learning, and remember that the knowledge you gain from this deep dive can empower you to make smarter decisions and live a more fulfilling life. Until next time, happy trading and happy living.